So the thing that's interesting is from an entrepreneurial view, a 5x return is sort of a life-changing difference. But to a venture portfolio, it's a rounding error. Like it's basically like, so in a sense, the venture funds incentives are to just drive for the, right, the megacorn, right? And so I guess what I'm trying to say is that people are making deals that they don't understand the implications of. They're making deals with a very asymmetric partner who has very different goals from them. And that there may be a temporary alignment where there's kind of the world is puffy and filled with promise, but like it may be that at some point they might regret making the promises they made.
Presented by Zapier, the AI automation company.
Hello and welcome to the Exponential Scale podcast, the show where we talk about how tiny teams with big ambitions are doing more with less, scaling smarter, not harder, and building big businesses with teams that could fit around a dinner table. I'm your host, Ron Schmelzer, and on today's episode, we're tackling a question that every small team founder wrestles with. Can a truly small, high-leverage company actually raise venture capital? Should it, and how? And our guest is Miko Matsumura, who's the managing partner at Gumi Cryptos Capital, and he's going to give us the honest answer from both sides of the VC table, and of course, insights into what's happening with Web3, tiny teams, and AI, which is saying, if you're not doing AI and you're a tiny team, you're not doing it right. So, hey, Miko, thank you so much for joining us.
Yeah, I'm excited to talk about it.
Yeah, this is fantastic. So before we jump in, I want to let you all know that Miko and I, we go way back. Decades. I don't even know if I want to say how many.
Oh, geez.
Yeah, that's some big stuff here. So in my past life, I ran an analyst firm called ZapThink, and Miko was a client. His company was a client, and we worked together during the SOA days. Some of you may remember that, service-oriented architecture, back when that was the hot thing that everyone was trying to figure out, at least in the enterprise. Nowhere near as hot as AI, by the way. If I asked my mom about SOA, she'd be like, but if you talk to her about AI, she's like, oh yeah, look what I just did. So anyway, so this is more than just an interview for me. I really respect Miko. I've been following him for a long time now, decades. And I really wanted to see how he thinks about leverage and ecosystems up close. That's why I wanted him on the show. He was posting recently. I'm like, I got to talk to him. He's got to be on here. And one thing you may or may not know about Miko, in 1990, while the rest of the world was still figuring out email, he was building a 33-parameter backpropagation neural network at Yale. And he went on to lead Java evangelism at Sun Microsystems, grew that developer community from thousands to millions, raised over $50 million as a founder, then flipped the script to become a VC, deploying $130 million, picking unicorns like OpenSea and Yield Guild games before anyone had ever heard of them. Maybe you heard of them, maybe you haven't, but in the Web3 space, they're definitely big. So what I really want to dig into today is what all of this means for the small team founder, because the venture industry was built for scale, for sure. Investing, taking risks, taking small amounts of money and making them big. That's the game, right? But it was really built for companies that scaled in, I would say, more traditional way. It's weird to say that, but the venture world is built on this traditional headcount-focused growth method. And the whole model really assumes that you're going to scale by hiring. But what does that mean for the small teams now, the solo founders, which have actually traditionally been frowned upon by the venture universe? One team, one founder, that seems risky, right? The 3-person company that's already generating real revenue, do they even have a shot or need for raising? And is VC even the machine that everyone wants to get into? So we're going to get into all that sort of stuff. We're going to wrestle with it. But enough from me. I think you want to hear about Miko. Miko, tell us a little bit about Gumi Cryptos Capital as well, and kind of bring us up to speed with kind of who you are and what you're doing and why you're here.
Yeah, absolutely. So, back in 2018, we pretty much kicked off this initial fund vehicle, $21 million crypto fund, knocked out some really, really early stage stuff and some pretty deep tech speculative things in Web3. Obviously, you mentioned some of them, 1inch and OpenSea, probably a total of about 8 or so unicorn scale outcomes out of that fund vehicle. We are in our second vintage with Fund 2, which is a $110 million vehicle. And, from our vantage point, a lot of what you're describing is foundational and transformational, especially with the advent of these machine, sophisticated machine intelligences, that are on this kind of hyperscaling cycle, right? So, in a way, like huge transformation. I think you mentioned, my Yale neuroscience, degree, and part of the thing that happened between that time and today is the Transformers paper, right? So the essentially people are talking about intelligence as a monolithic construct, right? But the thing that's really interesting when you think about attention is people talk about machine intelligence and machine learning, right? But they don't really talk about machine attention as being foundational, right? They're not like, like, let's talk about artificial attention. And it's like, this artificial attention is the biggest thing to happen, right? Because the backpropagation of error was known in like the late 1980s, right? And so we were, so in terms of what people call machine learning is effectively the backpropagation of error through an abstract neural network, right? So the thing that changed is really is artificial attention, is that what happens within this Boltzmann is that you can basically do gradient descent around this paradigm of the dot product, right? So if you've studied simple kind of vectorization, you understand this cosine similarity, which is you understand this kind of 3072 dimensional Matryoshka vector embedding, this kind of vibe, right? You understand it, right? You understand how a cat and a dog are different, right? It's like they're both pets, and like one of them is they're both furry, but like, so you start to understand these multiple dimensional vectors, right? But the thing that attention added is the dot product, right? Which is basically that the vector actually has a length, right? So the length of the vector is not just the angle where it's like these two things are similar, but it's like these two things are similar, but this one's important. Right? The length of the dot product, right? So the thing, machine attention was really the thing that changed. So like people talk about GPT, transformers are the T, right? The concept of it being generative and the construct of it being pre-trained, it's all backprop. It's the same thing. So since 1990, that's the one thing that has materially changed. Obviously, the availability of compute obviously has changed, right? So there's the amount of compute is insane, right? Jensen delivered crazy GPU, it's insane, right? The amount of data that's just lying around in piles is insane, right? So I'm not saying nothing changed, but what changed in the kind of AI neuroscience world is attention. Like that's what changed. That's the biggest change, and algorithmically. So we're here. So the reason why I'm giving all this kind of preamble is that I think what's most important is to understand exactly what you said, which is what is the leverage? Like what happens when you confer attention onto machines, right? And people who are thinking about this in a very coarsely grained way are just reasoning that the machines have become intelligent, right? And by how? Not by accruing the ability to learn, which they already had. It's actually by the ability to attend, right? That attention, that's the thing. So the question becomes, what's the leverage in machine attention? Turns out it's pretty big.
Pretty big. Well, good. Well, I do for our listeners, something that might seem a little technical. I was going to sort of compact all of that for you. I'm going to perform the job of a large language model right now. I'm going to compact that conversation a little bit for you here. But basically, long and short of all of that technical discussion was mainly to say that, we've trained these machines. We've been doing this training of machines for a really long time and building these models, honestly, for a very long time. But that seminal paper, the attention is all you need paper, the one that basically kicked off the chat GPT revolution, which, as you mentioned, is just an application of this large pre-trained model.
Yeah, before it was chat GPT.
Right.
There was no transformers. Right. That's what the T is.
But now this actually goes back to the previous company that I sold, Cognitica, was that the big transformation also wasn't just that these models were available, but it also shifted the amount of complexity that the user needed. Because for a long time, you needed to be a data scientist and a machine learning engineer to really get anything, honestly, of value out of any sort of model. But what happened was that with the idea of attention, I'm going to sort of put it back here, is that you could enter a small amount of text, a prompt, and you can get a huge amount of text or a different amount of text or whatever transformation of that text into something else. And that's what we're grappling at now. And of course, what's happened is that people can speak, people can do language, people can think. And so when they apply their speaking and their language and thinking to models, they get these what seem to be magical outcomes. Even though the thing
For sure.
I actually like the word magic because when you know how a magic trick works, you know that nobody defied the laws of physics. We didn't magically make something disappear from one location and reappear another location or chop somebody actually in half. You're like, oh, that's how the trick works. I think more people should understand how the magic trick works of large
Yeah.
language models. But a lot of it does come to these are models trained on a lot of data, which they may or may not always have had the rights to use, but
Correct.
nonetheless, they're in the model. So that's actually big. So let's get back into this transformation, and I think this leverage. So that's what this podcast is all about. Is
Leverage.
that hey, this is putting the power of all of this capability into the hands of individuals, and I think that is fundamentally changing the landscape of venture because it used to be just like you had to be a data scientist, a machine learning engineer to do something with AI. You had to be a developer to build applications. You had to be a designer to build stuff. You had to be a copyright person to write stuff. Now you don't. So the question is, well, do we need to have money leveraged or is the technology leverage all we really need? We don't is that kind of all we need right now instead of just attention.
Yeah. I mean, I feel like the thing that you're describing is tremendous. If you go back to Guy Kawasaki's rules for revolutionaries, one of the rules was eat like a bird, shit like an elephant, right? So this idea of creating outsized impact with undersized investment, right, really is 100% leverage and leverage only, right? So the thing that I think becomes so important becomes that the scope of the value chain kind of gets collapsed into a singularity, right? Because effectively, when you look at like a 4-pillar startup, it's like engineering, and then there's, product, and then there's sales, and then there's marketing, right? And it's essentially like, yeah, those are all skill domains, right? But the thing that's fascinating about what happened today is that you can have a solo founder that can do everything, because why shouldn't they? They can do their own engineering, they can do their own product, they can do their own, and obviously it up levels the skill of having good taste, or it up levels the moat of like understanding the world, and so a lot of these types of skills become more skills that actually swing all the way back towards things like the humanities, right? Where you understanding problems, like what are problems? What is a problem? Like, how do you think about problems? How do you solve problems, right? All of these things, and in a sense, the how becomes sort of subordinate to the why, right? Which is understanding reasons, right? Because people exhibit things like behaviors, right? Like purchasing behaviors, like customer behaviors, retention behaviors, whatever it is, all of these behaviors are purposeful, right? People all have their own behaviors in the world, right? So understanding and, meaning and these kinds of things become really powerful framings within which entrepreneurs can create tremendous leverage.
Yeah, and I think that's interesting that you bring that up. And actually, one of you mentioned the word taste, which is kind of an interesting word that kind of sets me off in a couple of directions because I actually wrote about this actually for a piece in Forbes once, and that is that a lot of things you're talking about are the intangibles, which is critical thinking and creativity and common sense, which machines are still not really very good at any of those things. But when you talk about things like taste, these intangibles, and like I've heard like investors like we're investing on ideas of taste. Like, what does that mean? What is that actually? Is it more just like you have a strong opinion about the way something should work? Yeah.
So I think the biggest moat becomes taste is more like a buzzword, right? But the thing that I think is the real moat is more like mindset, right? Like, for example, like I am a big fan of like Homer and like the Odyssey. Right now it's the Odyssey.
I was thinking, you talking the Odyssey or Simpson? I was going to go either
Odyssey, yeah. And when I was younger, it was Simpson. No, when I was younger, it was the Iliad, actually, right? But now that I'm a little older, it's about the Odyssey. But the point I'm trying to make is that there are ancient books, and when you pick up an ancient book, right, you're mostly reading winners. And what I mean by winners is Homer's a winner because like Christopher Nolan is making a movie in 2026 about freaking Odysseus, right? Like what the hell is even happening, right? Like what I'm trying to say is that like the losers are all gone, right? Like there's probably a billion books that have been written by humans and like almost all of them are like forever forgotten because they were pretty useless or whatever, right? Whereas like so why am I talking about this? The reason I'm talking about it is there are books that people can read over and over and over and over for their entire life. And every time they read it again, this book produces more meaning and then they're more excited and then they're more excited to even read it again another time, right? Why? What is it? Why is this true? It's true because it's a mindset, that there's a deep mindset, that there's culture, there's encoded knowledge, there's traditions, there's like philosophy, there's linguistics, there's like everything's embedded in these ancient texts that are so vital to humankind. I think, every major world spiritual tradition is kind of forced to answer the question of like, why is it bad here? And they all take a crack at it and they all have their own way of explaining the answer to that question. Those books, people read them every day and they just, these are kind of like 1 billion monthly active users, with year 2000 retention, level, success stories, right? In terms of if you think of these as apps, right? So I guess what I'm trying to argue is that mindset is really productive of outcomes, right? Where if the person has a good mindset, then that mindset becomes something, because how do you replicate the mindset, right? Like the mindset is something that a person has developed over their entire life. So in a way, like, mindset becomes a moat. Taste is really downstream of mindset. So, in a way, like if you have a really interesting mindset, then what comes out are all of these things that people value, but they're downstream. Like contrarianism is downstream of your mindset, right? Like, taste is downstream of your mindset and all of your output is downstream of your mindset, right? So to me, like mindset is really big. And I can tell you one of the biggest mindsets that I think is impactful is the mindset of continuous improvement, right? Like if you have the mindset of continuous improvement, like the leverage is just, it's insane.
Yeah, there's this common theme out there for those of you who have seen it probably on LinkedIn or wherever else. It's that 1% thing, which is like, well, all you got to do is just be 1% better. I don't know what the time frame is. Is it on a daily, weekly, monthly? I don't know. But the idea is this compounding, like the compounding interest, the compounding of leverage. If you get 1% better and you do it over and over again, soon enough, that 1%
So,
becomes pretty
so,
huge,
so,
right?
so I don't know if you all read like Atomic Habits, right? James Clear, but like it's absolutely the core insight, right? Which is if you have a 1% compounding improvement, right? What happens is that curve is asymptotic to the vertical. Like that's what that 1% compounding is, right? If you have a 1% decrease that compound, you
Yeah.
asymptote the horizontal.
Right.
You have asymptote the horizontal. Like the thing that's cool
I'm
about
trying
it
the
is
exponentially up or the exponentially down for all of our
yeah, it's either
listeners.
vertical or horizontal, right?
Yeah.
The thing that's interesting is this, though, which is that the good news about asymptoting the horizontal is that the rate at which you descend actually slows, right? As you get closer and closer to zero, right? But like, but in a sense
You'll
that
never hit
that
the bottom, but you'll just slowly get there.
but the idea that you can asymptote the vertical, obviously the idea of any organic system going vertical is like, obviously, a purely vertical asymptote means you go up by infinity percent, like on an instantaneous basis, right? So, natural systems don't become vertical. They don't go vertical on the slope. But like to me, that kind of idea of compounding is really the core idea of the production of leverage, right? Which to me, when you think about systems that learn, right, the systems that learn are so intriguing because you have the ability for this loop of continuous improvement to be embodied within a system, right? So that's the excitement, I think, around these types of attention bearing continuous improvement and learning, self-learning systems, right? Those are super exciting because ultimately it comes out into frameworks. So a lot of what you described in terms of my career history, really are things like complex emergent systems, right? Like when you think about Java, the Java language, the relationship between the Java language platform and developers, right? The emergence of things like service-oriented architecture and the kind of multiplicative and combinatoric complexity of deploying services and then combinatorically consuming services. Like that's another mechanism of like platform thinking, right? And then obviously when you think about this emergence of this idea of a platform, right, the idea becomes that ultimately these complex systems form data compression and they form essentially these almost linguistic boundaries where intelligence transmits across the sort of fundamental units, right? So you have all these little units, and then the units basically form this kind of data compression construct where they're all self-communicative.
Yeah,
I mean,
things are
you could
clumpy.
see it in
Things,
biological evolution.
yeah, clusters. So Miko,
Yes.
obviously, not talking like an investor.
Fair enough.
Which is good. Which is good. Nothing wrong with that at all. And I think for many people, there's people understand at different levels of that complexity curve. And I encourage people to listen to this podcast at least 20 or 30 times. Maybe not as many times as you listen to the Odyssey here or Homer, whatever you need to listen to there. But I want to get into that investor mindset a little bit here, because I'll put this out a little bit because having gone through different instances of this myself. So ChannelWave, that first company, we raised a traditional round of venture capital, grew really big, were acquired by a public company, had so many preferences in there that, liquidation preferences, which gives the venture, for those that understand, that gives the venture capital they get a guaranteed amount out of any exit transaction before anybody else gets anything. And there can be multiples. They get a guaranteed 2x of their return or 3x of their return. And when you raise a lot of money, these things kind of stack on each other. And of course, we raised a lot of money. It was acquired for a bunch of money, and I basically saw very little of it at the end. Even though I was one of the founders, I was like almost a 50% founder. Second company, ZapThink, which you all know, didn't raise a penny, bootstrapped that thing, grew to multiple millions of dollars in revenue. We were acquired by a professional consulting firm, sold it for cash. I had no lock, which meant I could walk away the next day, and I did. And I dumped my other co-founder there, Jason. He ended up working for that company for a year or so before he left. And then I started another company, and and I sort of, when I did some venture and I did some angel investing myself, and very mixed returns. And I have to say, I have a very mixed feeling about venture capital, and people who have seen me write about it, especially the writings on the Scalebrate site, see that I'm not actually that positive about it. I think there's a lot of issues with venture capital, and one that there's a very small number of winners. Obviously, that's just the way that power law works. I think when the winners happen, the outcomes are highly, like the investors win out the most. The early founders, if there are any, they win a bunch, and then everybody else kind of gets screwed, to be totally honest. Like all the other employees, the customers, you've heard everything about enshtittification, that systems just over time just get worse. Private equity is like a slur word. And if you talk to people about VC, I don't think people are that positive about it. So,
so let me
bring me into your mindset.
So I've been in 25 years in entrepreneurship, and then an additional past 8 years in venture, right? And I think to me, like it's really important to understand that both of these things are businesses, right? That venture capital is a business, right? And that entrepreneurship is a business. Startups are a business, right? They're businesses, right? And businesses have to be constituted to make money, right? And effectively, the thing that I think is important to understand are the incentives and how each of these organisms become successful, right? Because if you think about them as economic organisms, then what they're doing is they're exchanging energy in the form of dollars, right? And the thing why do they do it? Like, why do VCs act the way they do, right? And it's simple, right? It's just their economics and the way they're incentivized drives certain behaviors, and like it's natural, right? So to me, I think one of the things that entrepreneurs maybe don't think through that clearly is how do they make their partner successful under the terms that their partner needs, right? And then if they really understood the end-to-end model, would they even enter into an agreement like that, right? And so the answer oftentimes is no, right? Oftentimes what happens is that there's a lot of flowery promises on both sides, right? But the way that the model works in venture is very clear, right? Which is that you swing for the fences every single time, right? And most of them don't, because there's a simple concept of fund returner, right? Which is effectively that you make one investment and that investment has such a high multiple, even given your considerably minority position in that, right? Because you invested, whatever you invested, some millions of dollars or whatever, but like you don't own that much of this company, even at IPO, right? Because there's dilution, et cetera, right? So the point I'm trying to make is that the outcomes have to be 100x, 1000x, 10,000x, like they have to be cosmologically large. Right. And so the point I'm trying to argue is that to me, if you look at the fund's portfolio composition, right, the thing that's funny about the incentives is that when you look at the fund returners being 1000x, 10,000x returns, right, then the thing that's funny becomes that mathematically a 5x return or a 3x return or a 2x return or a 1x return or a 0x return are mathematically very similar to a VC. Right. So the thing that's interesting is from an entrepreneurial view, a 5x return is sort of a life-changing difference. But to a venture portfolio, it's a rounding error. Like it's basically like, so in a sense, the venture funds incentives are to just drive for the megacorn, right? And so I guess what I'm trying to say is that people are making deals that they don't understand the implications of. They're making deals with a very asymmetric partner who has very different goals from them, and that there may be a temporary alignment where there's kind of the world is puffy and filled with promise, but like it may be that at some point they might regret making the promises they made, right? So, in a way, I feel like the thing that's interesting becomes if you don't like the consequences, don't make the promises, right? And don't take the money from someone who's going to want the kinds of returns that they're going to want, right? So I guess what I'm trying to say is that there's a world of misunderstanding between VCs and entrepreneurs, a world of misunderstanding.
Yeah.
And I feel like, there's a lot of words that get tossed around like evil. And it's basically like,
I won't use those words. I won't use those words, but
people do use those words.
And there's probably some reasons why they use those words. But I think instead of using the words evil or good, because that doesn't make any sense. You're right. These are businesses, and so businesses are businesses. They have motivations. They
want to succeed.
So there's a couple things and a lot of things in there. Like, I think the first thing is that the motivations, obviously, for entrepreneurs and venture capital are not aligned, and probably, like as you mentioned,
I would say this in many cases, in almost all cases they're not, but in the rare cases,
in a few cases,
rare cases they are wildly aligned.
Right. And I think what has happened is that the story of entrepreneurship, especially the story of tech entrepreneurship, has been that the venture path is the preferred path, is the primary path. But as you mentioned, as you know, for most organizations doesn't make any sense. And like the way I like to think about it,
factually correct.
The way I like to think about it is that from a venture perspective, the product, if you want to think of it, that is being sold, if you want to think of it this way, because a venture company is investing, is buying a product, right? And they're buying a product for one
financial product, equity.
Yeah, and exactly. So the
equity-like instrument.
Exactly. That's exactly right. So this product that a company is selling is not the product that they sell to their customers. The product they're selling is a portion of their company. The equity is the product, right?
Correct.
And their job is to make that product worth more, because the venture business is to take the product that they own at one price and find some way. Yeah, exactly. Not that much. That's not much difficult. When you're saying like, and I'm agreeing with you. I mean, a lot of these things are not disagreements. They're just more mindset, right? We get back to mindset, right? And I think people say like, hey, you shouldn't really be investing if you don't know the product, right? If you shouldn't be selling your product if you don't know who you're selling it to and what they want from the product. These are all logical perspectives, but they start to, now when we get back to where we started from, this whole idea of leverage for scaling, which is that now people have so much control over leverage in their own hands. It makes people wonder, like, well, should should I focus my efforts on selling the primary product, which is the goods and services that I'm selling, or should I be trying to sell the other product, which is a piece of my company?
Money.
When the likelihoods, when sort of like, I would be happy, you're right, I would be totally happy with a 10x return, a 20x return, a 50x return would be fantastic. But when you're talking about scales, you're like, wait a sec, we've got to start at 1,000x, 2,000x.
I mean, a 5x return is a 500% return on investment, right? Like that is appreciable. Like that is potentially life-changing. Like that is good.
For the founder.
So from But just if you are a business and you do 500% return on investment on your business, you are a good business, right? Now,
yeah,
you know,
and
in a venture portfolio,
you're a dog.
You're pretty close to the same as zero.
Yeah, exactly. Which is I think is why a lot of people are starting to question it. Now, when people say venture is evil, I don't think venture or private equity, because people do think of both of those things. I think they look at what happens to the companies after that's what they're looking at. They're looking at the outcomes. And I think a lot to be said there and I think the reason why enshtittification is such a thing, for those of you that don't know about it, you should learn about it, which is the idea that over time products just get worse because the sort of the benefits need to accrue not to the customers, but need to accrue to the investors. Right?
So, Cory Doctorow,
exactly.
Yes.
And it's made its way into like the vernacular. So let's think about it that way. Let's sort of, shift the boat here. Is there perhaps just a different model? Is there just perhaps a different way where investors could say, hey, I want to participate in these high growth companies. These high growth companies don't need a lot of capital. The exits might be a lot smaller. But maybe there is a world in which a 5 to 10 to 50x return would be just as phenomenal for the investor too.
No. I believe there is. And honestly, one of the things that I believe is that there is a new deal or a novel economic organism, and that to me, I feel like the Japanese keiretsu style of business, right? The shared economic concern that's represented by the kind of equity swaps and these kinds of like slightly more protectionistic, or maybe you could call them feudalistic, types of structures, I think are resurgent, right? So I feel like one of the things that I think could be resurgent, because to me, there's two elements that are involved in things like the death of SaaS software, right? And I'm a subscriber. I think there's a lot of people that are kind of screaming against this thesis, but I think it's true, which is that there's the thing about what is SaaS? SaaS is I'm smarter than you, which means that I can extract an ever-growing tax on your dumbness, right? That's what the thesis is for SaaS, right? And the thing that's funny is when you commoditize the availability of intelligence, it falls apart, right? Which is basically like, well, now we're all equally intelligent and you can't do anything to me.
Well,
right?
yeah, I might put it in a slightly different way. I mean, the way I would like to think about it is that when building is hard, when development is difficult, and when things like managing infrastructure and dealing with lots of customers is difficult, then sort of buying capability on a monthly basis or whatever the subscription basis becomes a good economic argument.
That's fine.
Right.
That's fine. You're making a nuanced and mindset driven, adjustment to what I said. But
I don't disagree with
me.
I don't disagree with it. I agree with you about where this may end up.
The conclusion.
Exactly.
So, but let me go one step further, right? Which is, it means that we might enter an era that's AI driven, where effectively the corporate investor becomes really strategic and interesting, right? Where people used to use the phrase strategic investor, but the thing that's really interesting is, what if your company is delivering existential AI software, right? Because think about this. The asteroid is hit. The asteroid has already hit. So like, if you're a dinosaur, what do you do, right? Now, evolution actually has the playbook, right? Which is, if you're a dinosaur, evolution says, take to the air, grow some feathers, get up off the ground, decrease your body size, right? Just get out of this business, right? Like, don't be so large. Like, it's not going to work out well, right? Now, if you're a mammal, it's like, become furry and become social, because that's good, and become smart, right? Like, grow an absurdly large brain, right, that consumes 20 to 25% of your metabolic energy. Head explodes, right? If you're a baby, it consumes 30 to 40% of your metabolic energy, your brain. Right.
Yeah.
And it's not even very amazing when you're a baby. Like your brain is actually, it's highly
Just
consumptive.
growing very fast.
Yeah. And you're doing a lot of like
making
training.
a lot of connections, right? Exactly.
Yeah. You're doing a lot of back propagation almost constantly, right? So it's tough to be a baby. But what am I arguing? What I'm arguing is if your AI product is existential to one of these dinosaurs and transforming them, right? Then why shouldn't they give you millions of dollars, right? But the point about giving you millions of dollars is they're not going to give it to you on the revenue line. That makes no sense. It makes no sense at all. They cannot do it.
You mean
they cannot give you millions of dollars in SaaS fees? They're not going to do that, right? But the product is valuable. Like the product, if the product is whether they grow a brain or whether the enterprise lives or dies, right? So if it's an existential product, what they should do is they should become a strategic investor, right? And when you go to your IPO, they should make a boatload of money off of your success, right? Because what happens is that's more like the Japanese keiretsu model, right? Whereas effectively what happens is that the misalignment goes away, where you're now a shared economic concern, right? Where the provider of the intelligence is now part of the same tribe. You're part of the same tribe. You have shared interests. You both want success for each other, right? This is a big change. So, I feel like, feel like this type of model is something that we'll see that's more emergent, right? If you look at the PE segment, right, there's actually an opportunity for non-predatory PE, private equity, right? There's an opportunity for it, right? Which is that instead of putting lipstick on pigs, making companies look like one thing through financial engineering that they're not, and then trying to strip out the cost by firing all the humans, like they don't have to do that anymore. They can actually take like a really amazing AI brain. They can amplify like an incredible like founder who actually understands the customers, and they can basically have that person become the center of this like, federated almost roll-up company or this with an AI brain. So I guess what I'm arguing is that like your thesis, I think, is spot on, right? Which is I think that the flow of capital will change fundamentally. And you're seeing like super amazing VCs like Khosla that were like super early into things like OpenAI, right? Like you're seeing them actually going into private equity, right? You're seeing things like simultaneously OpenAI and Anthropic building joint ventures with Wall Street to do private equity.
Yeah.
And there may be a new private equity that's less rapacious, that's less purely kind of fire all the humans, like
extracting a value.
So to me, I feel like new economic agreements are arising.
There's so much in there. I have to unpack. There's so much there, and I want to be mindful of our listeners here, and I want to dig into a couple of things. So, first of all, the keiretsu idea, right? The thing that I think a lot of people aren't familiar with this, but basically these aren't necessarily customers in the sense of customers, that you have sort of an alliance, between companies. It's basically companies who have a vested interest in each other existing, but aren't necessarily in each other's business.
Let me unpack it. So the word keiretsu is a Japanese word, and one of the famous ones is Mitsubishi, right? So most people have seen Mitsubishi. Sometimes they're like, oh, it's a car company or whatever, right? And it turns out, it's also a bank.
Yeah, they make ships. They make ships.
Yeah, and it's like, what is happening, right? So it's sort of like these classical Japanese industrial conglomerate thing, right? Like when you look, so in Korea, they're called chaebol, which is like Samsung or all these different things, right? But at the base, there's like a bank, right? And what happens is that these companies all swap equity with each other, right? So for example, what happens that's crazy is that they become money spinners, right? So if you look at something like Mitsubishi Motors, they're like, oh, I need millions of yen to buy auto parts from Mitsubishi Parts, right? So what happens is Mitsubishi Bank loans the money to Mitsubishi Motors gives the money to Mitsubishi Parts, and then Mitsubishi Parts puts it back in the bank.
And what's confusing is
it's pure money spinner.
Now
and
they
it's
share
all Mitsubishi.
Well, what's confusing that they share the same name, Mitsubishi, but in that relationship, there are distinct entities, because otherwise they would just be internally passing the money around. There wouldn't be like a banking relationship, because if they were truly
that's the keiretsu model. So at the beginning, At the beginning, there was a model called zaibatsu.
Mm-hmm.
And this goes back to the days of the shogun, right? Because the thing that's crazy, when you look at the Mitsubishi, Mitsu is 3, Bishi is like this rhombus, these diamond shape. So if you look at the logo on a car, Mitsubishi car, it's 3 diamonds, right?
Mm-hmm.
This is actually the mon. It's the shogun. It's the family crest of the Mitsubishi family. So if you go back to the dynasty, like they're in the battle flag, they're flying the Mitsubishi, right? So like
Wow.
this. So the zaibatsu were actually, so zaibatsu means family wealth concern, right? So it used to be conglomerated under the central power, which was the family, right? And the family had 100% control over every single company. And then what happened after World War II is they evolved into this thing called keiretsu. And what a keiretsu is it's equity swaps. And that the thing that's the difference is this, is it's the difference between feudalism and federalism, which is essentially that in feudalism, the central power wins by fiat. So if there's ever any dispute, the central power just crushes the regional power and says, I'm the king, you're not. The end, right? In the keiretsu model, which is a federal model, what happens is the economy decides. So if the thing wants to drift away from the central and sell equity to the public or do whatever they want, right? And they want to kind of break out, like the economy decides. Like whatever's economically sensible will be, the result. So that's the keiretsu model. But in the keiretsu model, there's still shared economic interest. And when you think about something like the lowest risk-adjusted cost of capital, there isn't one for the motor company to get the loan. Like there's no source of capital that has a better risk-adjusted cost of capital than Mitsubishi Bank. Like they're the ones. Like they're like, no, we know you. We know your balance sheet. We understand your company. We know your operations. Like we know everything. This is the best risk-adjusted cost of capital. Here's your money. And by the way, it comes straight back into the bank, as I pointed out, right? Which is amazing.
Well, the reason why the light bulb moment went off for me, and this is probably not strictly in the keiretsu model, right? Not in that classic sense, right? But if you think about what's been happening in AI, right? And you've been thinking about the relationships. I know you know this because you've been seeing this. You know that there's a relationship between OpenAI and Nvidia and Microsoft.
100%.
And they are both customers, but
100%.
also investors. And there's this funny little meme that's going around. I think it's a Three Stooges meme where, Moe says, I owe you $20, here's 10, but I owe you later. Then it's like, on the Mo's like, oh wait, I owe you $20, here's 10, but I owe you later. Then Larry's like, oh wait, I owe you $20, here's 10, I owe you later. And then all of a sudden it goes around, it's like, hey, well, I guess we all paid each other back because it's the same money, just kind of transferring its way around. It's feeling like, wait a second, are we building? These aren't investors in the classic sense. These are sort of like shareholders with vested interests, not invested interests, right?
100%. When you look at the compute providers, right? When you look at Google Cloud, you look at Amazon, you look at Amazon Anthropic, you look at Microsoft, you look at Azure, you look at all of these things. Like you look at like Colossus, which is obviously Elon, all of these things are all forming these effectively cartel-like structures, right? Where they're essentially creating money spinners, right? So this is part of sort of the new novel emergent economic federation. But I feel like from a scaling perspective, the beauty of this becomes scale invariance. So scale invariance is super important, which is what you need to look for as organizing principles are ratios, right? So the thing that's really fascinating is things like a P&L ratio is a ratio. So another one is the reserve to float ratio. When you think about things like reserve banking, equity buybacks, when you think about these structures, those are, again, ratios. The reason why I'm talking about the importance of ratios is a ratio is scale invariant. It's scale invariant, which means that the same things that these giant companies are doing, any company can do.
Yeah, well, let's bring it back to brass tacks here, because I want to think about this, because you might think, well, wait a second, this may make you feel powerless. You're like, wait a second, I have no control, I have no power. These are large companies doing large company things with large amounts of money. There's no way I can play in that. I'm thinking, wait, two can play at this game. So if we're thinking about
that's the point.
Yeah, if we're a bunch of small companies, we don't, as said, we don't need to scale to the same levels. I'm happy being a $10 million, or a $20 million, $50 million company, but can we as a group sort of I don't want to use the word
100%.
collude, but like because we as a group kind of grow together, be like, you know what? Hey, let's do this in a
That's
smart
correct.
way. I don't need to. Yes, I can use your revenue. I can use you as a customer, but I would much rather have you as a member of my alliance. When I started Scalebrate originally, I called it the Scalebrate Alliance, and I think that made people think it was weird, so I just called it the Hub. But, but basically, it's this idea that maybe together as small groups, that we're happy with, I would say, limited amounts of scale, significant scale, but we don't have to get to unicorn level, right? We don't have, but we can achieve together as a collection much more than we can apart. So the question is, then how does that we do need a different funding? Like we can't do the same, you just said risk adjusted, returns. We can't do the swing for the fences. We can't do the 1000x returns because we have to because of the power laws. There's got to be something different here.
So here's what I propose, right? Which is one of the areas where we're seeing major collapses, like Blue Owl, right, is private credit, right? And the thing that the private credit industry didn't quite predict, although in hindsight, it's super obvious, is that the borrowers went completely feral and the lenders went completely feral, right? So the point is that like everybody's lying to everybody else, right? And so what's happening is just toxic debt piling up, and it's kind of the reason why people are really nervous about private credit is because they're remembering 2008, right? Like when you see toxic assets piling up in a corner, you start to feel a little nervous because you're basically like, if that blows up, like who's holding the bag and what are the ripple effects and how much derivative leverage is there on top of the base asset, right? And if the base asset's toxic, what happens to all of us, right? Like, are we going to die now as an economy? So the point I'm trying to make is when you look at this idea of something like the keiretsu model, right? The thing that's exciting becomes that this idea of the risk-adjusted cost of capital, right, is so interesting because what I'll tell you, the amazing thing that's happened in my segment, right, is really the Genius Act, which is effectively the idea of the issuance of regulated, fully backed stable coins. Like a stable coin issuer is a bank. Right. And so the thing that's really insane becomes that we have the opportunity to create these keiretsu banks. Right. So you can create your own Mitsubishi bank and you can effectively enable the dynamic circulation and the wildly capital efficient circulation of private credit within a federation. Right. So that becomes like a really interesting opportunity, for redistributing capital. And to me, the thing that's fascinating is not only is the Stablecoin Act interesting, right, which enables you to deal with essentially the P&L ratio, right, which is really the lending equation, right, which is the lending equation has to do with P&L, right? But when I talked about things like stock buybacks and I talked about the reserve to float ratio, right, the thing that's super fascinating is the upcoming Clarity Act, because what the Clarity Act unlocks is so-called real-world assets, including equities. And the thing that's so fascinating about what happens there is not only are you now able to have a fully captive Mitsubishi bank, but you're able to create a fully captive Bank of Japan, right? Because what happens then is that you begin to handle your own reserve assets, you begin to do your own central banking, and you basically buy and sell the equities of the Federation members. And that becomes the economic driver for this keiretsu model. So to me, I feel like it's pretty fascinating because then you have a reserve bank or central bank, and you have a merchant bank. Right. So all of these things effectively can become essentially captives, right? Where you can essentially create an economic federation where these two resources are utilities that kind of power
this is a bigger conversation. Because now we're basically saying, I mean, I'm not necessarily disagreeing with you, and this is really a much bigger conversation, but that we may be saying that we may need a new economic model in general to sustain.
I mean, it's when I say new, like I'm going back to like ancient Japanese history. So like some of this isn't
For
that
you,
new,
but look,
right? Some of the mechanisms are new.
and I think for, I think this does ring a lot of bells for people who talk about things like late stage capitalism, where I think there's the feeling that right now the winning accrues to a small number of people. And I think to go back to that's the reason why people say, I'm not necessarily saying that this is everybody says this, but the people do say that things like private equity and venture capital on the balance between good and not good are balanced towards not good because these outcomes
I
are
mean, they
basically
contribute to wealth
they can
inequality.
yeah, they do that, but they also for those who are trying to win, if you will, at the entrepreneurship game, it's hard to win when you're competing against. I'll put it straight. Like if you're trying to sell software as a service, let's just say we'll talk about the future of software as a service later. But like just say you're selling for something for $50 a month. And you're just like, I just want to, I don't want a 1,000x return. I'm happy to 10x, 20x, 50x. I want a sustainable. I want to get to $2 million a year, 5 million, 10 million. I'll be happy at 20 million, et cetera. But what happens is you go up against a venture-backed competitor. The venture-backed competitor, what they do
Will
is
scorch the earth.
yeah, they do go, I'll give it away
They'll
for
scorch the
free.
earth. Free.
Well, and then what ends up happening is that there's that sucking sound. All the customers who would much rather not pay at all, they kind of go to the venture company. And then what happens with the venture company is the enshtittification happens at that point. Thank you very much for your customers. Then they basically make sure that the competitors go away. Then they basically put on the squeeze. The features get worse over time. The prices go up. And this is happening everywhere. As a matter of fact, there's a big conversation about this happening right now at Substack and how Substack has gone from the,
yeah. That's why I'm so interested in the equity swapping element, right? Because with the equity swapping element, it places everyone into the same boat, right? Where the customer wishes for the vendor's success and the vendor wishes for the customer's success. And everybody's now tied together, right? Because if your business is choking out your customer, right, the result is you choked out your customer, right? Like you're not going to love the result. Like
okay.
you have dead customers.
And this brings us back, because I have so many questions for you, and I want to be mindful of your time and my time, and I want to get into some of the, but like
open up a big can of worms.
Oh my goodness! Like, let's just talk about everything. Why don't we? But this actually does get back to the story about the SaaS and ending of SaaS. And I'll tell you sort of like not a personal story, but my personal experience. I think a lot of the reason why people have been talking about the end of SaaS is not because software as a service is going to go away. I mean, obviously, we're going to have software as a service. The thing is, like, a lot of the large SaaS vendors have been doing exactly what you've been saying, which is kind of choking out the customer, whether you're a HubSpot or a Salesforce or wherever it is. There's the feeling that it's extracting, it's not adding value. And here's the thing. Now with AI, the power dynamic has shifted. And in a very specific case, I had a situation where I was using this platform. It did not have what I wanted to have. The price was going up. It was not going down. And I just decided, screw it. I understand that maybe building something is not necessarily the smartest decision I could be making because I have to weigh my cost and my time. But it was more like I just hit the wall. I'm like, I'm not willing to invest anymore in the other company's platform. I'm not willing to be a SaaS slave where the features will just get worse over time and I'll be squeezed to pay more for less. And and I think that's what people are missing in the SaaS argument. It's like, nobody's going to build their own software because the functionality is going to be the same and you have to manage. It's like, you're forgetting the direction that if I keep telling you that the SaaS alternative is just going to get more expensive with less capability over time, that rate of return, risk adjusted.
Yeah. So to me, the thing that I am calling for is not just these generic commodity utilities of merchant banking and reserve banking, right? But what I'm also calling for is that providers of software become part of the nucleus of a federation, right? Because in a sense, it's the brains of the organization, right? So as you begin to federate a collection of companies, that the sources of data management and intelligence actually become organically part of the organism, right? So, it's fascinating because people talk about extractive and predatory business models and this type of thing, right? And they're really talking about the history of competition, right? And the history of egocentrism, right? Which is, if you go back in evolutionary times, to the last universal common ancestor, right? The commonality of this organism is basically individual survival, right? So everyone looks at evolution as a story of Darwinism and like this kind of individual survival, which is a very old impulse, to be perfectly honest, right? But the thing that I've been studying is not social primatism, which is sort of this idea of like, let's work together, apes together strong, right? But it's more going back to the origins of multicellularity, right? Where multicellularity is like, oh, like you pump out ATP and I'll build us an immune system. And it's like, okay, cool, right? And the guy who's pumping out ATP isn't like, why the hell am I giving this guy my ATP? It's like, bro, like he's giving you an immune system, like, you better deliver, like give him the stuff, right? And it's sort of like ATP is money, like this energy is money. Why am I giving away my money? And it's like, bro, you're not giving away your money, like you're getting an immune system. So it's sort of like, if you go back to the origins of multicellularity, like this is really deep cooperation. So, I feel like that's the picture I want to paint to kind of close out, is that like, economic federation's possible. Like we can do it. We can build like regenerative economies. We can build powerful economies, and we can do it with scale and variance. Like, I think that's the key, is look for these golden ratios. Don't just sit there like with powerless and think that the big guy is always going to win. Like, the power, the magic power is percentage of growth, right? Like I can grow, if I grow my revenue from 0 cents to 1 cent.
Yeah, exactly.
I just had infinity percent growth, infinity percent growth. Like, do you think Google can get infinity percent growth? No, I don't think they can, right? Obviously, if you get to 2 pennies, it's, 100% growth over your first penny, right? So like, so to me, that's how the little guy can win.
Yeah. Well, hey, I had like about 15 questions. I just threw out all the questions. We got into a lot of it. I think this is great. I think this, hopefully for listeners, hopefully this gives you a lot of things to chew on. This is some really interesting stuff. Now I have rapid fire questions. I got to ask the same 3 rapid fire questions I ask everybody.
Fire away.
They're all the key. They're real simple, but like, let's get into tools. So the first one is, what is one tool or automation that you absolutely can't run your business without? The one that gives you and your team.
This is gonna sound so like mid curve, right? But honest to Pete, it's like Claude Code. Like,
okay.
And honest to Pete, it's like 20x max. Like I'm token maxing every day, and like that's what it's doing it for a lot of people. Essential. It is essential.
That's fantastic. Like, how are you, like, what's some, maybe one way you're using it that you may think people may not have considered for their own use of Claude?
Nah, it's all mid-curve stuff. Like, I'm just banging out software. Like, obviously, software
coding
is a lot more personal in the sense that it's software about kind of either discovery, FAFO discovery mode, or it's just make personal effectiveness, right? So but I feel like that's
personal interest and personal productivity, basically.
Yeah, correct.
Nothing wrong with that. That's what software's for. And now a process question. So what is, especially we didn't have time to talk about some of your portfolio companies, especially the ones that have been really growing very well, scaling really fast and been doing a lot of stuff we've been talking about. So this is that process question. What's one system or process do you think every lean leverage first team should have in place by the time they hit their first $1 million in revenue that separates the scalers, the ones who are getting that compound leverage, from the grinders? They worked really hard to get that first $1 million. They'll work twice as hard to get that second $1 million. That's not scaling. That's not leverage. So what do you think, maybe what would you tell people to stop doing that they might be doing that's preventing scale, or something that they should start doing today?
I mean, I really feel like weirdly culture is sort of an X factor, right? Because ultimately at some point there's inflection, and ultimately at some point there's transformation. And ultimately what I'm talking about is the S shape, right? Which is that there's stuff that works and you're exponential, like your show, but then it's the S curve, right? It's not the hockey stick, it's the S, right? So the question becomes, what happens when the thing stops doing the thing, and what's the scale, right? Because I talked about fractal scale invariance, right? So there's some scale at which it becomes an S, right? And like the population of the Earth seems like it's like 10.5 billion, right? So there's some S's that are like big S's, and there's some S's that are really small, right? So you don't know. So to me, the thing that's really fascinating is it turns out that things like culture actually help you go through these messy transformations where maybe the curve you thought was like 10 billion is actually much smaller, and now you have to change, right? Now you have to deal with the consequences, because, I think a lot of these are predicated on these infinitely exponential. There's no
Right.
such thing as infinitely
No.
exponential. Like all bounded earthly systems like cap out. So the question becomes, what do you do now?
That's actually a really fun way of thinking about things. We talked about these like exponential curves, exponential up, asymptotic vertical, and asymptotic horizontal, right?
Yeah.
And I guess the best way for me to think about it is that when you're starting your business, everything feels asymptotic horizontal. Like you're spending all of this
you haven't
time,
seen the turn.
and it's just going, you're just like not making any progress, and stuff is just kind of getting worse and worse and worse every day. Then all of a sudden something happens, and then it's like, boom, we got that exponential, the vertical,
right.
which is like, oh, things are growing and growing. Can I keep it growing? But then the point of the S curve is that at some point that asymptotic vertical goes horizontal again, where it's like, no matter how much you try to improve, and no matter how much you try to improve, you're just going to hit that. You're hitting it may not be horizontal at zero, but it's horizontal at some other point. So I really like the way you put that. And maybe people don't think about it from those mathematical perspective, but that's basically kind of what
they're all sigmoids. Everything is S-shaped.
That's good. And that's why we were making a lot of the economic argument. Well, what if we had a whole bunch of small sigmoids all collected together instead of the one big one? And so
could be beautiful.
Yeah, that could be a beautiful thing. I think we're in alignment on that. So the final thing is a tip. So if you can give one piece of advice to a founder who's running that dinner table size team right now, who wants to scale, what would you share?
Yeah, I mean, I think in this day and age, it really feels like the watchword is really what I would call FAFO, right? Which is F around and find out. Because the cost of effing around has been decreased, right? And because the experimentation is something that you can actually manifest in things like software, right? So you can speculatively spam out like 10 experiments that are maybe not going anywhere, but maybe the 11th experiment goes somewhere, right? So to me, like, I'm big in the mood of this. If you want to watch like a really long podcast, right? Like Peter Steinberger, the OpenClaw guy, right? Like if you want to watch that podcast, there's like a 3.5 hour long podcast, with him, talking about it. And the conclusion I came hearing that podcast was basically FAFO is king, right? Which is this guy was basically like, the reason I beat everyone at this game is that my goal was to have the most fun for myself, and that there were these giant companies and there were 0 employees of any of the giant companies whose goal it was to have the most fun for themselves, right? And so when you think about that from an evolutionary perspective, that's bananas, right? Like that is major FAFO. Like that is someone in a weird corner of some weird universe doing some weird thing, and just bang, like out of the blue, they hit the numbers and they became $1 billion enterprise overnight.
Whatever, yeah. Well, that's great. Well, I tend not to think of that as, usually FAFO is like the negative thing. It's like you screw around, you're going to find out.
I'm reclaiming it. I am reclaiming the phrase.
I like to think of it as trial and error, but I think this is good. I think this is good. Well, hey, this has definitely sparked a lot of conversation. Didn't necessarily go the way I think any of us were thinking. But that's why I was here. Like, I just wanted to pick your brain, kind of get again in your mindset how you were thinking about this. So, Miko, thanks again for joining us here on the Exponential Scale podcast. I encourage people to reach out to you. So, Miko, tell us, where can people find out more about you, the fund, the things you're working on?
Yeah, give us all the content. The easiest place is if you go to mikobits.com, mikobits.com. You can find my LinkedIn's or my socials, Twitter, wherever DM's open. So you can just hit my webpage and then you can go from there to anywhere you want, and you can basically chat me up, and I'm happy to hear pitches. I'm happy to hear about your companies. I'm happy to hear about anything you want to talk about.
Maybe we'll be starting a bank soon. Stay tuned. I wouldn't necessarily rule that out. But anyway, well, again, I want to thank you, Mika, so much for joining us. And as usual, I always end with a mantra for the week and an outro for you all. And that is, here's your mantra for the week. Trial and error, FAFO, if you want to think of it that way, is the best way to get from that horizontal exponent where all you can do is you're not going 1% up, you're just kind of going 1% down, to get to the vertical, You get that vertical. Now, by the time it gets to the horizontal again, you really want to make it sustainable. And perhaps that's not necessarily a bad place to be. So I think if you've loved this interview with Miko Matsumura, I want you to hit that subscribe button, leave a review, and share with that founder friend who's still chasing the headcount instead of leverage. I want you to think big, stay lean, and scale smarter. Micro teams aren't the future, they're the now. If this episode got you fired up, hit that subscribe button, share it with your crew, and join the movement over at scalebrate.com. That's SCALEBRATE.com. Till next time, think big, stay lean, and scale smarter. Because you're not a tiny team, you're a micro team with mega potential. So get exponential, and thanks for tuning in to the Exponential Scale Podcast.